Are we in a bubble? I do not believe so. And I am very happy that many people are worrying that we're in a bubble. I experienced the late 90s bubble. And yeah, the value investors out there were really worried. And they think they're going to have their day in the sun again because they did so well during the tech and telecom bust. I don't think that's the case now.
Well, you know what, when I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little more comfortable. I like bad news and maybe news that's not, the discounting is worse now than the news actually will be. I actually feel better in that kind of environment for our strategies. I don't think we're in a bubble, which is what I think many bears think we are. In a bubble, and I remember the late 90s, our strategy would have been cheered on, rah, 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 go get them, right? And you remember the leapfrogging of analysts making estimates, one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or SPACs coming out and falling to earth. We couldn't be further away from a bubble. And the reason for that is the innovation around which we have centered our research. These 5 platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, are barely off the ground. The seeds for all of these platforms were planted in the 20 years that ended in the tech and telecom bust. And ended in tears, and there's a lot of muscle memory around that. But that's not what's going on right now. The seeds planted back then are beginning to flourish now, and it's just beginning with 5 platforms involving 14 different technologies, all of which are about to experience S-curves and feed one another's S-curves. I don't think the market's ready for this. That's what I meant. We've dedicated our research and investing to innovation because we think we've never been at a more provocative time for innovation in history.
Are we in a bubble? I do not believe so. And I am very happy that many people are worrying that we're in a bubble. I experienced the late 90s bubble, and yeah, the value investors out there were really worried, and they think they're going to have their day in the sun again because they did so well during the tech and telecom bust. I don't think that's the case now. I think that the seeds for what we're experiencing now were planted back then. Too much capital chased those opportunities too soon. After too few opportunities, there were too few opportunities, and the technologies weren't right. The costs were way too high. We're at prime time for those 5 platforms now and those 14 technologies. And we've just begun. And they're going to be very disruptive and maybe destructive to a lot of value spaces. Not everyone, but anyone looking at price to book, watch out for that book. It may disappear because of disruptive innovation. Anyone looking at that high dividend yield saying, I got to hold on to the stock. Be suspicious of high dividend yields if that company is in harm's way. And I would say there's about 50% of the S&P 500 in harm's way. Why don't we? I think we're in a bubble because if you look at equity flows since the beginning of 2018, and remember, we had a big market in 2017, so you'd have expected flows to really start to gush. What has happened since then is there's been net liquidation. If you just look at ETFs and mutual funds, there's been a liquidation to the tune of $350 billion if you take away share repurchases. Don't count those. But if you look at fixed income, there has been a net inflow of roughly $900 billion. So think about that, a $1.2 trillion gap there. I will not believe we are in a bubble, equities that is, until we see that relationship flip.
I don't think the wrapper matters that much. I think our research is the differentiator. And the way we've set up our research department is a differentiator. Unlike traditional asset management firms, our analysts do not follow sectors. They follow technologies, the 14 different technologies that I mentioned involved in these 5 major innovation platforms. So they are technology specialists, and they are generalists when it comes to sectors. So we have a very good idea based on our analysis of these technologies and Wright's Law. Wright's Law, we've centered our research around it. Wright's Law is a relative of Moore's Law. But Moore's Law is a function of time. Wright's Law is a function of units. And Wright's Law has worked better in the semiconductor industry recently than Moore's Law has. So we think that's a very important gauge of how quickly these costs are going to decline over time. And we also pay a lot of attention to price elasticity of demand. At what point in this cost or price decline trajectory will new sectors open up to these new technologies? And so I think what we are able to see is our exponential growth trends that are not priced into the market. I'll give you the easiest example. Last year, EV sales were 2.2 million units around the world. We think based on the declining costs of battery pack systems that electric vehicle prices will drop below gas-powered prices in a year or so. They're already lower from a total cost of ownership point of view. So we think that 2.2 million will be 40 million in 5 years, in 2025, not even 5 years. No one is forecasting that. So the starting point from the top down, using Wright's Law, getting a sense of how quickly the costs associated with these technologies are falling, and how quickly, therefore, they will be taken up by more and more sectors and industries over time.